Good evening and happy Monday. What's going on, my people? Welcome. Good to be with you today. We're going to get started in just a minute here, guys. It's tax day tomorrow, and we're doing a whole lot right now when it comes to getting people filed and extended. Always a great time of year for people like me. Okay, been in the grind mode today, and I'm grateful for the people that trust me to take care of the tax work, and I don't dishonor that trust. So, guys, good to be with you again. If you didn't know, let's get it started, guys. Tonight we're going to talk about, should your trucking or construction business be a C-Corp? And pretty cool graphic here. I got this design with AI at the last minute here because I wanted to get something that related to what we're talking about tonight. Testing out this technology, man. See how it's working. I recommend that everybody does this. And let's just get this started right now, guys. If you didn't know, now you know. This is me, Cheston Bulgin, CFO tax strategist. Your accounting superhero. You can reach us at 8884-BTB now, 888-428-2669. That's 888-428-2669. You can reach us on the web at youraccountingsuperhero.com. You can also reach me directly at cbulgin@youraccountingsuperhero.com. And definitely you can follow me on Instagram at Your Accounting Superhero. Welcome everybody who's on Instagram, who's in this conversation today. Good to be with you. Happy Monday. And really quick disclaimer before we get started. The following is for educational purposes only. It is not to be considered financial, accounting, or legal advice. Please consult your tax, accounting, and or legal professional for specific advice. And just to bring it back home with you guys today, we're going to be talking about C-Corps. It's interesting because I've seen a few people recently that have come and they've had C-Corp structured for their business, and it hasn't really been clear as to why they structured it that way. And it could be, you could structure a C-Corp for your business, but you want to know exactly when and how to do that and what are the benefits for it. Some of you may be thinking that there's a higher benefit to being a C corporation versus how you're structured today. Maybe you're thinking about for, credit and all these, the funding your business and everything to make sure that you're separating yourself from your business in that way. And that's the idea, that's the concept. And we want to create it in a way where it's very clear for people moving forward. And it might take a couple of calls to get clear on this for everybody involved to make sure that this is something that you can consider for yourself and understand if you're not a C Corp, what's the best structure for you? What makes sense for your business? What makes sense for how you're going to operate in the future? What makes sense for your future? How you're going to retire? How you're going to extract income? All those things. It's very important to understand the structure, because if your structure is out of alignment, then it can go wrong for you in so many different ways. So you want to consider that for yourselves. And, I want to go over the main functions of this entity structure. Okay, I want to go over the main functions of this entity structure. So for those of you who don't know, C Corps are a type of entity for business operations. It's a separate entity from yourself altogether. It makes your business separate from you. But that's not the only thing that does that, okay? All right, but let's talk about it for some of the pros and cons. All right, we're going to talk about the realm of it first. Okay, so the realm of this, when you think about it like this: asset protection, tax benefit, capitalization. These are the main areas that we're going to look at in terms of the pros and cons today with a C Corp. And we're going to answer that question: does it make sense for you, and how does it benefit you as a business owner to move into the structure or to stay away from the structure? Okay. All right. So hopefully this will be of value to you tonight. We're going to give you a few basics around it, and hopefully give you something that you can take with you to have a high level conversation about with your professional. Okay. If you don't have a professional to speak to about this, you can definitely reach out to us. You know the way to reach us. I'll go back to that really quickly. You can reach us at 888-4BTB now. That's 888-428-2669. 888-428-2669. or on youraccountingsuperhero.com. Okay. If you need some direct assistance with that, of course, there should be a link inside of this live stream for you to go ahead and click connect and get a call if you need some extra guidance with that as well. All right. But asset protection, tax benefit, capitalization, I want to go ahead and share something with you. Let me go ahead and share my screen, guys. I want to build this out with you together today. Build this out, guys. And let's make sure we got this. Here we go. There we go. All right. So let's make sure you guys can see this as well. Welcome. I see people popping on the call. Welcome. Happy Monday to you. Okay. Happy Monday. And that's kind of small right there. Let's see if we can make this bigger for you guys. No, I'm just going to make it maximize like this, guys, so you can see it. All right, so we're going to build this out today for you. Just to understand, number one, we're talking about C-Corps and the benefit of them. And the thing that we just said is like asset protection, all right? So we're going to talk about one. First thing we're going to talk about is asset protection. Why asset protection? What is it really? What is asset protection? If you know what that is, if you have an idea what that is, just put it in the chat for me, guys. If you're here in the call, you want to share and make sure you're engaged with us. I want to hear from you. What do you know about this? Like, what is asset protection? What is it to you? Why would you want it? Give me a synopsis of that for yourselves. I just want to gauge where you are in the conversation and what you understand by this so we can speak to the thing that's going to make the most difference for you tonight. Okay. And I want to know who I'm speaking to when I'm doing these live streams. Okay. And while you're doing that, I will say that, I've been around this game for more than 2 decades, man. I've been around this game for more than 2 decades. And it seems like I keep learning more things, right? So even if you're in the process of just thinking about what it means to you, whatever you're saying, it's okay, because it's an ever learning process is what I found out for myself, and I've been around this for a long time. So tell me what that is for you, okay? What that is to you. And I know that some people want to be shy in the conversation and not really share like that, but, give it what you got, okay? I remember starting out with companies and I wanted to do things by the book, which is why the company is called what it is, by the books consulting. It's like one of the things. The other component of that is because we do things, by the numbers. We like to look at the numbers to make these black and white decisions for life. Like, are we going to go this way or that way? Yes or no? Based on what the numbers are telling us. But I remember back in the day when I got started, I just wanted to understand how to do these things. I would look at publicly traded companies and, understand why their structure is a C-Corp. I would understand why they would build their financials in the way that they built their financials. I would actually discover that for myself so that I would know how to do it for my own businesses. I was curious that way. And I've maintained that curiosity even today to know exactly what would benefit my businesses and the people that are in my circle, their businesses as well. Right. But a lot of times, some of these basics like asset protection, they really don't get understood. It's like we say it, but what does it really mean for us? That's the question. What does it really mean? So asset protection, guys, basically what asset protection means is that I segment. This is what we get to do. Separation of liability between owners and business is owned by the owners. Let me just make sure it's a little wider. Such that liability is mitigated or reduced between entities. So what does that mean? Okay, what does that really mean? And that's my own definition for it as I'm putting it out here. I didn't look that up and like per se for this conversation, but based on my whole background understanding, I'm putting together like this so that we can have a conversation about it. And asset protection basically means that, you want to separate your risk exposure from the operating of the business and you. Okay. So whatever assets that you want to grow in terms of wealth, let's say that you're accumulating a lot of wealth in life. That's your goal, is to accumulate wealth. And you want to make sure that creditors or people who want to have lawsuits against you, they don't have necessarily the access to those assets that you're accumulating over time. So if you buy houses like real estate, land, you have bank accounts with cash in the bank. You have retirement accounts, you have brokerage accounts, you have offshore accounts. You might have invested in gold. You might have some funds in foreign exchange, and you've developed like multiple assets, a portfolio of assets all throughout your life, and you want to make sure that these assets are not at risk for you to lose them. And you also want to make sure that the business assets are not at risk to be lost as well. Now, these could be like, equipment that you're using in a trucking company or a construction company. You paid money for this. You've maybe gotten loans for it. You may invested in this equipment, and you want to make sure that you don't have to liquidate this to cover anything in a lawsuit, and shut down altogether. And if you did have to do that, if you did have a situation where you were forced into that situation, how can you make sure that that asset base is reduced to what's only available inside of that company that you operate? Okay, so we were reducing the risk in a sense to that company for one, and making sure that it's not spilling out into the other areas of your life. Maybe you have other companies that you own and you have your personal life. So you want to make sure that these assets are not at risk for being taken away or lost completely. Okay, so great thing, corporation, great way to limit the risk, all right, of exposure to loss. Okay, because whatever is in the side of that company can be the only thing or the only things that are exposed to risk of loss in the event that something like that does happen. Okay, so people don't have access to anything beyond that company. We call it a corporate veil. It's protected. You don't have to consider losing the things inside of that company because you have a well-oriented structure. And the C-Corp is one of the ways that people like to do that. And I want to say that all these companies, like LLCs and S-Corps, are designed to do that, to give asset protection, as long as the business itself is operating as its own entity. It's not the same as you. Okay, so if we're going to say the business is a separate entity, it just doesn't want to be said that just doesn't want to be said about it. Rather, you actually want to show up that way in real life, like separate bank accounts, bookkeeping structure, corporate minutes for meetings throughout the year, annual meetings and annual reviews and reports, All of that wants to be in place to ensure that your company is operating as a separate entity in and of its own. So it wants to have its own cash flow. It wants to have its own, set of books. It wants to have its own reporting methods separate than you. And it doesn't want to be the case where you're taking money out of that business to pay your own personal expenses directly from that business, because then what will happen is you could pierce that corporate veil and you will not have the same protection of your assets. It's like you are now defeating the whole purpose of forming an organization to have that type of asset protection that I mentioned before. Hopefully that makes sense, guys. So it's a big deal that a lot of people get into C-Corps because they expect that it's going to have a higher level of asset protection. Well, and not necessarily the case, 100% of the time it's not necessarily the case, because all of the structures that we have in business are designed to do that. Like if you have an S-Corp, it's designed to have asset protection. That's the whole point of the structure. If you have an LLC, a limited liability corporation, it is also designed to have asset protection the same way. They all have that corporate veil. As long as you treat it like a business separate than yourself, then you'll have that protection all the way around. All right. Hopefully that makes sense to you. So, in terms of like choosing a C Corp solely for this purpose, I wouldn't necessarily say that that's a sole reason for choosing a C Corp. There are other factors that you want to consider when choosing a C Corp to run your business. The main reason I'm having this call today is because people get into a C Corp and they run into a lot of other problems. Like how you're going to get paid. That's one of the things I want to talk about here tonight too, is like, because if you have this corporate setup and you want to get paid kind of like how you've been getting paid as a sole proprietor, where you just take money out of the business, and cut a check from you to the business as a distribution or a draw, doesn't necessarily fly the same way if you're going to be a C Corp, because technically that money doesn't belong to you. It belongs to the corporation, right? It doesn't belong to you. It belongs to the corporation. That's really one of the segmenting factors of a C Corp. And what do I mean by that? Well, C Corps are taxed on their own. Now, it's amazing to me that, a lot of entrepreneurs don't really understand the difference between what we call pass-through entities and other entities that are not pass-through. So pass-through entities mainly means that the entity does not have necessarily taxable income of its own. It doesn't have taxable income of its own. The taxable income flows through to the owners of that company. So it does file a tax return, but that only serves to report, well, how much of this income is taxable to the shareholders on the other side of it. Once it gets flowed and thrown through, once it goes through or passes through to the owners, we want to have a clarity on, well, how much of that is flowing through to each of the owners, the shareholders in an S Corp, or, the partners in a partnership, or whatever that looks like. Okay. But, the main difference here is because inside of this conversation is that C Corps are not, they're not flow through entities. They have taxability in and of themselves. And because of that, you can't really extract money the same way, because technically it's not your money to take from it. Okay. So what I'll see is that people will come in and they'll have the C Corp and they're taking draws from the C Corp. It's like, what are you doing, man? You're not supposed to do that, right? You don't do that with the C Corp. You want to make sure that the two ways you're going to extract that is, like, you want to have a dividend policy. That's one. You can issue dividend on a quarterly basis or semi-annual basis or annual basis. You can do dividends or however that looks. It could be on monthly basis, monthly dividends, but you want to make sure that when you have that dividend policy, the 1099 is issued to the people who are receiving dividends, like the owners who are receiving dividends from that company on a C Corp. The other way is wages. You get paid a W-2 wage. Other than that, there's no way. You're not going to cut out distribution checks from a C Corp and have it be compliant. Okay, that's one of the things you don't want to do. You're going to get into trouble like that, compliance-wise. So it makes it complicated for owners that are used to doing that, right? So typically, small business owners, what they would like to do is be able to use that money from their business in the early stages to support their income. I'm not saying you can't do that with a C Corp. You just want to do it in a way where it's compliant, and then you want to know that you're going to have something we call double taxation, okay, which we're going to get to next. We're going to talk about this next thing that we have on the board here, which is tax benefits. Okay, So tax benefits for this are something that we want to look at, because there are benefits to this and there are cons to this. There are pros and there are cons to this when it comes to C Corps. Now, one of the main cons that I just talked about was double taxation. Nobody wants to be taxed double. That doesn't even sound good, does it? No, it doesn't sound good to have double taxation. And what it means is that the corporation is taxed, yes. And then whatever money that you get from the corporation, that is also taxed. Get that, okay? So let's say that, your corporation, and let's look at double taxation really quickly on this little blueprint here, guys. Let's say, let me just get this separated here. Let's talk about taxes. So let's say your C Corp has, 100K and net income, profits. Okay, that's the profit. So that's its taxable income. Okay, so it gets taxed on this 100K. And even at that level, it gets taxed, right? So now the corporate tax rate right now, say that's about $21,000. Let's just say it's about $21,000 of corporate tax. All right, 21K. And not only do you get taxed on that, let's say that you want to have money come out of that. Let's say you want money to come out of that business to you, and you say, I'm just going to cut myself a check as a dividend from that corporation. Right? Now, at the least, dividends get taxed at capital gains tax rate. Right? Now, this money, like let's say you get $50,000 from this corporation. Well, this will also get taxed. It was already taxed at the 100,000, but then 50,000 is 100,000 will get taxed again when you cut the check to yourself. Okay, and that's going to be, somewhere around dividend tax. That's going to equal somewhere around, at least the minimum, $7,500. Okay. So it's taxed on the same money, is what it is. Okay. Now, if you took the whole thing, it'd be $15,000 of a dividend tax that you would pay. So total, if you do the minimum, you factor it's like $28,500. At the maximum, it could be up to $36,000 that you're taxed on this money, as opposed to just being taxed your ordinary income tax rate in a flow-through entity. They wouldn't have any corporate tax. We just have tax at the almost at that dividend level, but it's not really a dividend rate. It's actually at your ordinary income rate for that money. Okay. And depending on how you're set up, otherwise, we can talk about self-employment tax and all those other structures. But if you're an S Corp, you're just paying that self-employment tax on the amount of wages that you pay yourself, which you would have to pay on your corporation, your C Corp, anyway, if you took a check from there. For example, if you took a check from the C Corp, let's say for the other 50,000, right? Paycheck. right? For the other 15,000, so you get another 50K. Technically, that 50K would reduce this amount, right? It would reduce the 100,000 net income to 50,000 net income. So this would be reduced by half. The tax would be reduced to 10,500, right? If you took that check. So I'll just put that up here. That's just saying 10,500 if you're paying yourself a paycheck. That would actually be reduced by half because you're taking half of those profits and putting them into a paycheck, right? But then this paycheck would have, 7.625% here. Well, let's put it down here, okay? So it's going to be another 15.3% on this, okay? So the tax on your paycheck equals, first you have, let's just put it down here like this. Next line. First, you're going to have your self-employment tax, which is both sides of that because you're the corporation. I'm just putting that down here in your individual side, even though this portion of it would be on the corporation side too. So you got two sides of the 7.625%, which equals 15.3%, right, of that paycheck, which is just about $7,600, right? Right, on your paycheck, like the tax on your paycheck, that's one side of it. Then you have ordinary income tax, which is at your ordinary tax rate. And let's say your ordinary tax rate is at, if you're married, you'll be at right around 12% of that, right? In that pay range, about 12% if you're married filing joint return. And so that would be on the 12%, you got about $6,000. So that would be the total tax on your paycheck. More or less, all right? So you got like $13,625 of tax just on the paycheck and that you got to pay. All right, so this is what it looks like to have double taxation. You can't just have the tax be on one side of it. You added a side. You added a side of the C-Corp where you could have just had the single on the individual side, the tax to deal with there, but now you have tax to deal with the corporation, not to mention state tax, corporate state tax, okay, and corporate individual tax. This is all federal, what I put up here, okay? But I want you to get an illustration of this, just getting a general idea of what you have to think about when it comes to having a C-Corp, the double taxation. So why would anybody do this for tax reasons? Well, I would say the only reason that somebody would do this if they just want to control assets, but they don't need them. If you don't need the money to use inside of your own personal life, and you want to have control over the assets to do things inside the company with those assets, then it makes sense to have, for tax purposes, a C-Corp. Why? Because you're only taxed at the corporate rate. You don't have the double taxation. You don't even need to take a paycheck if you don't want to take money out of that for your personal life. That's not the case for a lot of small business owners, though. We want to take money out of that corporation in order to support our individual lifestyles. And because of that, then you're going to have to deal with double taxation, all right, for you on the individual side. A pretty cool thing to think about. So, I see a lot of people just taking C-Corps as an option as a small business owner. And I'm like, well, why? Why are you doing that? Did you think it through? Or do you understand what the ramifications if you want to extract money from it? And what do you need to do in order to do that in a compliant way so you stay out of trouble and also not deal with double taxation, right? So it's a lot of things that we want to work around when you don't necessarily have to do that with a C-Corp, okay? It makes sense when you want to control assets but not have access to them personally. Okay, it makes sense when you want to do it like that. If you just want to have the corporation do what it does, you control all the assets in the company to do what it does, fantastic. And you don't necessarily want to use this as a vehicle to continue to extract money from it personally. Okay, or you're going to be dealing with these things. All right. A pretty cool thing to think about. The last thing I want to discuss about this, guys, is when it comes to this, when it comes to C-Corps, we're going to talk about capitalization. Okay. So people want to build business credit. They want to do all kinds of things. Say, I need a C-Corp to build business credit. Do you really? Do you really? Okay. And also, how much capital are you looking to have, and how are you looking to get capital? Are you looking to use a lot of debt to fund your company? Are you looking to use a lot of profits to fund your company, like flip your profits back into the business? Are you going to invest it yourself into the company? Are you going to get other investors to invest in this? You're going to get people to fund your company for you. Now, all of that wants to be in a consideration when you talk about capitalization. Now, depending on it, the way you want to do it, we can look at that and say, does it line up with C-Corp? Okay, does it line up? Does it measure up? Is it in alignment with that? Now, typically with a C-Corp, you want to have like a capital structure where you're going out there, you're raising capital like people in the stock market, publicly traded company. We have unlimited capacity to create shares and raise capital and fund your company that way. Okay, it makes a whole lot of sense. Now, if you're not doing that, well, it doesn't make sense to be in a C-Corp. Capitalization wise, okay, because you can build business credit with an S-Corp. You can build a business credit with an LLC. You can do that, all right, pretty much similarly that you would be able to do it in a C-Corp. The only thing that you would not be able to do in all these other entities is be able to create a capital structure in which you can be publicly traded and have unlimited shareholders and raise capital unlimitedly in an unlimited way through that structure, okay? So, guys, I'm hoping you got some benefit from this basic foundation of basic communication of what C-Corps are and how they can benefit your trucking company, your construction company. Now, guys, put some chats in the comments, comment in the chat, all right, so that we can get back to you. If you're dealing with like wanting to get into a C-Corp, if you've been in a C-Corp and you really want to understand how to use it properly, well, put it in the chat here or book a call. There's a link here inside of this live stream that you can book a call directly with me or a member of my team to talk about that specifically in your scenario. Guys, it's been great being with you tonight. My name is Cheston Bolgen, your accounting superhero, and I'll talk to you next week. Happy tax time. Take care and bye-bye.